Look, it has been a very interesting couple of weeks for Chinese equities with the stimulus measures unveiled, a lot of liquidity support, property support measures too. And now there seems to be a big expectation that we're going to get more fiscal stimulus over the course of the weekend. Do you see this as China's whatever it takes moment?
Yes, I think they are going to continue to try to revive the market even more than it's been revived. And the reason for that, of course, is they want money to be coming into China. As you know, there's a lot of financing that's required, and foreign money coming in would help in this effort. So I think the Chinese want to see that market going much better than it's been going even now. Of course, there'll be corrections along the way, but you must remember the key point is that with China being something, depending on the index, 20 to 30% of any emerging market index. When China moves up dramatically the way it's done, the whole index moves up. And investors, which maybe 50% of all investors in emerging markets follow the index, they must put money into China. So we're in a situation now where China is going to be in a win-win situation. They have simulated the property market and other markets with lower interest rates and lower mortgage rates in particular. And this is going to help push up the market and encourage more foreign investors to come in. And of course, domestic investors. At the end of the day, domestic investors drive the market, but foreign investors are going to be very important, particularly the big institutional investors who've been very doubtful about China up to now.
It sounds to me that you're pretty bullish on where Chinese equities can go from here, despite the short-term volatility we've seen this week.
Yes, I think they're on the way to a more bullish, longer-term market, provided they continue these policies. And most significant is the statement by Xi Jinping was that he wanted to encourage enterprise. That's a very, very significant statement because before this time, there was a feeling that he was down on private enterprise. He wanted more lead by the government. But now it seems that the policies are beginning to change. So that's very, very significant. So it's going to be sort of an accelerating development with more and more people piling in as a result of the index moving up. Of course, India is doing so well. So you have these two powerhouses moving the index.
Yeah, you mentioned India, and I just wonder if you think there's going to be somewhat of an internal rotation within these MSCI emerging market indices, because India actually, metrics, is a lot richer. It's trading at around 25 PE ratio versus, say, the CSI 300 trading at a 16 PE ratio. Do you expect there to be some internal rotation within EM away from China plus countries, India, back into China again, given the valuation?
Yeah, there will be rotation. I would say, not say rotation, but I would say addition, because you must remember up to now, many investors, in fact, most of the big institutional investors were against China. They didn't want to hear anything about China because they got burned so badly. Now that's changing. As that money comes in, the total pool of money going into emerging markets will expand. So it doesn't mean that money will be pulled out of India, but money will be pulled into the index stocks, including and particularly China. And you're going to see this whole market moving. You must remember, emerging markets now are outperforming the U.S. market because of this dual situation with India and China moving up at such a good pace.
Though over the last year, though, the S&P is up about 30%. Some of these MSCI index, because of the China pullback, up until 2 weeks ago, was only up around 20%. Let me just ask you, looking ahead and piecing together what we have out of China, but also the indicators coming through from the U.S. economy, how do you expect the relative performance to be in 2025? Do you continue to think that the MSCI Emerging Markets Index is going to outperform U.S. markets?
I think the emerging markets will outperform for a number of reasons. First of all, I think the U.S. market will not do as well as it's been doing up to now because there's a lot of turmoil. Regardless of who wins the election, there'll be lots of turmoil taking place. Oil prices, if something blows up in the Middle East and Iran is attacked, oil prices will spike. and that won't be good for the U.S. economy, even though Trump may want to, if he wins, wants to pump up U.S. production. That takes time. It's not going to happen overnight. So I think the U.S. market will continue to do well, but not as well as the emerging markets.
Do you have a view on where the Fed are going to end up in this rate cutting cycle? And again, drawing on some comments that we had on Bloomberg TV with Jamie Dimon, the likes of Ray Dalio, both of them saying that investors shouldn't be surprised to see rates actually ending up higher than what is baked in. Where do you stand on that debate, sir?
That's a very, very good point that Diamond and others have made, and because they're kind of skeptical about the Fed lowering rates. I believe, and again, depending on how the election goes, I believe that after the election, the Fed will continue to lower rates simply because they realize that this is going to have an impact on the economy. And that I disagree with the idea that rates will go up again.